We're going to get started with the next segment, which is on pension reform. Between criminal justice, healthcare, pensions, we only tackle the easy stuff here at Georgia Public Policy Foundation. So now this is a very, very important topic, something that Georgia really needs to stay ahead of. It's something that we have an opportunity to do so, and we want to make sure we take that. So our panel is going to be led today by Len Gilroy, who's the head of the Pension Integrity Project for the Reason Foundation. He's going to give an overview of what Georgia faces and then call his fellow panelists up on the stage and introduce them. So please join me in welcoming Len Gilroy.
Thank you, Kyle. Thank you, everyone. It's a real honor to be here today. We've had a long and very productive relationship with the Georgia Public Policy Foundation over many years on a number of issues: infrastructure, government competition, and now looking at issues like public sector pensions and solvency issues related to this. So we're very thankful to have the opportunity to be here today, and as always, thankful to have the opportunity to continue to work with our great partners here in Georgia. So I'm fully aware that I'm coming after a big, thorny, complicated, costly issue like healthcare to come and talk about another big and complicated and costly issue, which is public sector pensions. And in this case, we're talking about, in particular, the teachers' retirement system of Georgia. So I will do my best to keep this short, sweet. I will try to keep, it gets pretty deep sometimes in terms of the numbers, but I'll try to keep it at a very high level, and certainly happy to answer any questions, afterwards that you guys may have, because this stuff can get pretty complicated. And then it will be followed by a panel where we'll be talking about this a little bit more in specifics and looking at what other states have done. But I want to add some context here, just to add some background to the discussion. So I want to give you a snapshot, if you will, or maybe some perspectives on the state of the teachers' retirement system of Georgia right now. And let me just say right off the bat, the project that I run is called the Pension Integrity Project at Reason Foundation. And what we do, our job is basically to look at troubled pension systems, or ones where there might be risks out there that folks maybe aren't fully aware of, and to draw those issues out and then work with motivated policymakers who want to take actions to reform these systems. And we'll talk about what that looks like and objectives of that sort of thing, because this sort of issue needs to be handled with a lot of care and caution, because ultimately what we're talking about are retirement benefits that have been promised to thousands and thousands of teachers across this state. And when you look at the nation, retirement benefits promised to thousands and thousands and millions of public sector workers. So this is meaningful. This is what people walk into employment. They basically sign a paper that says we'll sign up for this retirement benefit, and it's basically a guaranteed benefit from the state. And so we think that policymakers really need to make sure that they're watching the solvency of these systems to ensure that those benefits that have been promised are actually going to be there to be delivered in the end when the retirees need them when they retire. So let me just start by giving you a snapshot of where the system is today. I'm going to show you first something called a funded ratio, and this is basically just how much money you have in your assets relative to your liabilities. When I say liabilities, what that means is your promises, how much you have promised to retirees and folks working now for their retirement. And if you look at the trajectory of the last 20 years, what you see is a system that has gone from about being 100% funded down to around 75% funded, and over that time, this is what the debt picture looks like. And when we say underfunding, what we mean is what's that gap? That's what this red area is here. What this is showing the accumulation of unfunded liabilities, meaning promises that have been made for which the funds aren't there. And what you can see is for about 20 years ago, you were looking at a plan that was nearly fully funded, but today is looking at about $25 billion in promises that have been made that for which the resources aren't there. There's other ways to value this. There's a couple of different methodologies, so for a lot of the complicated accounting reasons, what we can basically tell you is that your plan right now is somewhere between 75 to 80% funded and generally around 20 to 25 billion dollars in unfunded liabilities. And that just depends on how you think about the future, because we have to project out for many, many, many decades into the future. And discount that back. There's lots of assumptions, and so the numbers can get complicated. But $20 to $25 billion of unfunded liabilities in a teacher pension plan is not insignificant. In fact, that's a very important thing we think to get a hold of. And just for perspective, it's in terms of your funded ratio in the mid-70s. You're better off than many pension plans. You're not as well off as some. It's certainly from that perspective. You're not. We're not saying that you're ranking low relative to other states. But that if you're not 100% funded, our perspective is that's a problem. You want to be 100% funded in a pension system, especially right now, like where we are, arguably is at the top of a market, and you want to be 100% funded at the top of a market. Just in terms of some other perspective, in terms of comparing maybe the growth of your pension liabilities, your pension contributions with the state economy, just mapping out the growth of your pension contributions to the TRS plan is the orange line on top since 2002, and you can see the blue line on the bottom is the GDP of Georgia. So that's a perspective just showing that the contribution rates are growing rapidly relative to the economy. And why is that happening? And one of the things that the actuaries for the plans do is they break out every year what's happening within the plan and what deviations from last year and the expectations have occurred. And so we went back and we sort of scraped that out for the last 20 years and looked at, if you look at those unfunded liabilities, about $24 billion on an actuarial basis. What does that break down to? What's causing that? A lot of people just intuitively believe, well, we had recessions and we had market crash. That will have a major impact. So of course, we're going to have that problem. But we're through that, so we're probably past that. But what you can see here is that that's just the first bar. That's the underperforming investments when you break out the categories. There are other things going on too. And so what you can see is that just under half of the problem of the unfunded liabilities is coming from that underperforming investment side. There are other factors going on. For instance, demographic assumptions. There's a whole range of those that cover everything from mortality, payroll growth, all sorts of things going on in there, where just being wrong on an assumption about how the future is going to look can have some real impacts on your unfunded liabilities. Also, negative amortization is another important factor. Which is basically your debt your pension debt is accumulating interest at a rate that you're not able to, your normal contributions are not even covering the interest on the debt, and so you're basically having this cycle of negative amortization, meaning you're growing the debt even though you're paying what the actuaries say is 100% of your bill, you are still having this problem where it's not actually tackling yet the interest that's just growing on that debt. So those are some problems. I won't go into all of it. But there are a variety of factors. So let's talk about just a couple of things here, just from the perspective of investment returns. This is the assumed rate of return for the plan. It's 7.5%. It's been there for a long time. 7.5 is a little bit high now relative to the rest of the country. Several years ago, we would have said that's probably a little low because many plans were at 8. But now the average across the country has fallen below this now. But that's their assumed rate of return on investments. This is the actual experience, and so this is what every pension plan looks like, and this is what your own portfolios, probably look like too, to a certain extent, which is there's a lot of volatility. Every year is going to be a pretty volatile thing, its own unique situation, and so what actuaries do is basically try to smooth that out, because if you were funding a pension plan based on the gray line, which is a crazy jumping, up and down volatile line, your budget, it would be difficult to budget around that because it's such a volatile thing. So actuaries try to smooth it out, and so they smooth that out over a period of several years. And so really what you're looking for is, well, where is that red line relative to the blue line? I mean, this is the simple way to think of it. Are you above your assumption or are you not? I mean, and if you're at or above it, you're going to be okay. If you're not, then that's a problem. What you can see is that there's been a consistent pattern for several years where that being under the line was an issue. And this is what we have the historical data for. You can take this back further. We also looked at this as a rolling average, a geometric rolling average over 10 years. And there, if you look at it on that basis, you can see the number hasn't exceeded that. Now, there are lots of ways to slice and dice this. And this is not saying that TRS is doing a bad job of investments or anything like that. They're actually, doing. This is This is normally what we often see in a lot of different pension plans out there. So we're not taking a shot at their investments or anything like that. This is just the reality that pension funds are living in these days. And just to look back over, you often hear pension funds themselves maybe talking about the last 30 years of a time horizon over performance. And we think it's actually, that may be extending too far back into the past because it's getting to a point in time at which it's really unrepresentative of the environment we live in now. Back 30 years ago, interest rates were sky high, double digits, mortgage rates were high in the same double digits. To hit a 7.5 or 8% assumed rate of return, you could invest in very, very safe assets and hit that. And so pension funds worked like that for many, many years. What's happened, though, in the last 20 or so is that we've had, a massive change in the global marketplace and in the economy, and we've seen a plummeting of global interest rates. And so you've had downward pressure on returns in the markets. And so what you see here is that's reflected in these numbers. And we're not trying to cherry pick periods. We just threw a bunch of different ranges here. If you look back over the last 5 years, everybody's doing pretty well. We've had, what some have called the Trump bump. You've had this market run up. And so that's what you see over the last 5 years. And so that's, that number looks normal relative to other plans that we see out there. But, you start going back, and that's where, the discrepancies start to really matter. You look back over 10, 15. We can only go back 17 years with the data that we had from their reporting from the plan. But what you can see is on any of those bases, they're not hitting that target. And we are not that optimistic that the future is going to look anywhere close to that rosy past of the late 80s or the excesses of the tech bubble and all of that. What we're looking at, and when you look at the capital market forecasts out there from lots of different companies that do this for a living, they are basically, they're tamping down expectations about future market growth, especially over the next decade. And so I won't belabor it, but what we're seeing a range of folks basically saying that because of those changes in the environment, you're going to see much lower returns on equities and bonds over the next few decades relative to what we have now. And so if you're a plan sitting there with a lot of unfunded liabilities and you're trying to recover to 100% funded status and you have a high rate of return relative to this kind of context, we think that's risky, and we think that is something that should be acknowledged now by policymakers. And what we're effectively doing by holding, we see this a lot in the public pension plan arena where you haven't seen the assumed rate of return assumptions sort of drop consistent with or commensurate with the change in the marketplace. And so pension funds have generally been somewhat slow to move those down. Now we're seeing it. We're seeing many plans now moving towards 7%. Some are even falling now below 7 into the 6s. And so we're starting to now see a recognition from pension plans, including CalPERS. CalPERS is the biggest one in the country. Their own investment advisors tell them they have a 6.2. Their next 10 years probably going to hit 6.2. And this is the biggest, most sophisticated pension plan in the country, if not, parts of the world. And so if that's what they're looking at, it's very hard for us to sort of look at this universe and think that 7.5% return is going to be a healthy thing for really most out there. And so what's happened is that because of that dynamic, what's really been happening is plans have been trying to chase returns. And what we've seen is, in many plans, a change in their composition of their portfolio to try to do that. Basically taking on more risk, rolling dice to try to hit an increasingly difficult target to hit. Now, in Georgia, it's actually compared to other states that we see that we've analyzed. You see a decline in the equities here from a little over 40%, a little over 50%, 55, 60% back in 2001. To just over 67 today. So there has been definitely an increase in equities, meaning putting more investment into things that have maybe higher risk and taking those assets out of the low risk category, if you will. And now we see other plans where that picture looks even more stark, where they're actually investing in. You see new tranches coming in of investments in alternatives, private equity, hedge funds, that sort of thing, real estate. Again, in an attempt to try to chase what is an increasingly difficult return target. To put a point on that, we like to think of things here in terms of probabilities and what's the probability of hitting that. And so what we've done here, this is a lot of numbers, so let me just kind of simplify this for you. What we've done is we've taken what the Georgia TRS folks, basically their expectations around their investments and the asset categories that they have, and we've run some modeling around that, and we think that they probably have about a 55 to 60% shot of hitting that 7.5% rate of return. However, when we go and we look at, and that's according to their own assumptions about what the future of their, the different asset classes that their investments are in, and how they're going to perform. Well, when we look at other institutions and what they think about the future of those same asset classes, and we map it out over that same basic allocation of assets, basically we think that if you're looking to try to just have a 50-50 shot of hitting it, which is what most plans are doing today, that number would be somewhere down in the 4 to 6% range, and that's significantly different. And so we think that there is a lower probability perhaps than maybe than the plan does in terms of what the likelihood of them hitting that target is. Well, what happens if you're wrong? What happens when assumptions are wrong? So I just want to show you, this is some sensitivity analysis that we've done around this. So the yellow line here, this is showing contribution rates on the employer side, and this is meaning the taxpayer side. Employees pay 6% into this, so this is the remainder. And so what you've seen is a ramp up in cost, definitely over the last decade. And what's going to happen? Well, moving forward, if the plan hits its 7.5%, what you would see is that we're probably near the peak, and then it'll start to taper off, and then ultimately over the next 30 years, and they're paying down that debt. That's basically why this stretches out so far. They're amortizing that $20+ billion in debt over this period, so it's going to take a long time for it to be done and paid off, but that's what that drop-off is at the end. But that's if they hit their assumption, in which they have not been doing. Well, what happens if it starts to look like 6.5% instead of 7.5%? And I mentioned a minute ago, CalPERS, the biggest pension plan in the country, they think 6.2 over the next decade is realistic. So this isn't a crazy number. Well, this is what that starts to look like, and you're basically looking at a significant increase. And if you go another round of 5.5, you drop it 200 basis points. What you can see is those rates start to really, really skyrocket. Another risk here is that one thing that's kind of interesting is that even the timing, even if you hit that return, on average, the timing of when those years and the good and the bad returns, the timing of when they sequence out may have an impact on your ability to get fully funded again. And so what we see is that contribution rates might be very different depending on, even if in all of these cases you're hitting on average over 30-year period your assumed return, but the timing is different. So the yellow one is the one I just showed you. That's from the plan assumption, and that's basically saying we're going to hit 7.5 every single year. But what happens if you start to change that, and it still averages out to the same number, but maybe you have big returns up front and lower over time, or vice versa? You start to see some really different outcomes in terms of contribution rates and then ultimately funded ratio of the plan and its ultimate solvency. And so this is an important issue. I talked about negative amortization, but I'm going to skip over that in the interest of time. And just to wrap up, the other thing that sort of gets exposed as you start to think about, well, is 7.5 the right number? We also have to think about how we discount these liabilities, how we price it, basically. How do you think about, because if somebody walks in and they take a pension benefit, they're going to be working for you for maybe a couple of decades, 30 years is the full retirement benefit. And then you will continue paying that benefit out for maybe another 20, 30 or plus if they're so fortunate. And then there may be a spousal benefit or surviving children benefit. So basically you're on the hook for decades of liabilities when somebody signs up and takes a job. And so you have to think about, this is a long-term thing. We have to think about all those dollars and then bring them back to today and discount it. And when you do that, there's lots of, you can make lots of assumptions. But once you start changing that assumption, right now the plan is at that 7.5, and that's where these numbers come from. But what you can see is those liabilities start to grow. Now this is on a market basis. I told you there were different numbers. I can explain that to anyone later. But what you can see is that depending on how you think about the future and what nobody really knows exactly, how many dollars have to go out of the system. So it's all sort of a very educated guess. You could have a radically your unfunded liabilities could actually be much more than the $20 or so billion that you have right now. So we think there's some risk in this system that needs to be acknowledged. And then finally, there's another thing about the benefit structure that we think is worth pointing out as you think about this system and how it's serving people. If you take, a group of 100 people walking into employment as a teacher right now, according to the plan's assumptions, basically you're going to lose 70 or 71 of them in the first 10 years before the vesting happens. You lose 50, over 50 in the first 5. And this is not an atypical, chart. We see this in a lot of plans. But what it say, and then you sort of then fast forward, and where you get the full retirement benefit is at 30 years. And what you see is that only about 17, 18% of people actually, of that cohort that walk in the door in year 1, will make it to that benefit level. And so you have a very expensive benefit system that is serving, a relatively small number of people that actually enter the teaching profession. And so I think it's a legitimate policy question just to think about, that the pension benefit is definitely serving those people to the right of that rightmost line. But the folks before that, that are either leaving, and if you leave before that first line, before 10 years, you're basically leaving your employer contributions in the system that were made on your behalf. So you're leaving money on the table that would have been in your benefit. And then if you leave in that middle gap period, you're getting something back, but not everything maybe, or for some of that period. And so a lot of people are just not being well served by this system, and that's even prompted some plans in other states. We saw in Louisiana, their version of the Georgia ERS plan this year proposed a reform that would have basically done what Georgia ERS did, which is move to a hybrid, because their interest was in portability, and what they were seeing internally was that their benefit wasn't exactly matching the modern workforce that's not necessarily attuned to a 30-year, tenure to get a benefit. And so they're even opening up notions of portability there. So just to, so what is, when you talk about reform, let's just put some discussion around that, because that's where this panel is going to go in a minute. These are the objectives that we use when we think about what does good pension reform look like. It's not about saving money, as the first and foremost goal. That's what a lot of people think. In fact, we often say, you should actually be spending more money, and I would say in this case, you should definitely be spending more money on this plan because it's going to need it. But keeping promises, we think, should be the first driver of any pension reform discussion. You've made billions of dollars of pension promises to hundreds of thousands of people out there, teachers, who are relying on it. And so it behooves policymakers to make sure 100% of that benefit is there and paid. And then looking at, retirement security as a primary goal for your benefits moving forward. And then balancing out those things of predictability and lowering risk and affordability. And there's trade-offs within that certainly need to be reckoned with, but those should be goals, together and sort of adjusted together. And then you have to look at, well, what's the modern workforce and the future workforce look like? Is this a good benefit for them? You have to compete. You have to compete with other states. You have to compete with other private entities and everyone else out there. So, this benefit doesn't live in a bubble. And then finally, you have to look at, this is the neglected stepchild of pension policy, but governance is a really important thing. How are decisions made? Where are the inputs coming from? Making sure that the governance and the decision-making is sound. I'll just to give how to think about something like this. So I just laid out some problems. There's more there. We've got a lot more to, that we could share. But, how do you think about this stuff? And so I think it's a 3-part, to simplify this and really wrap your head around it, I think it's 3 things. It's number 1, you got to pay off this unfunded liabilities as soon as possible. Right now, you guys are amortizing your pension debt over 30-year periods. And that's a long time. The actuarial profession, basically, that leaves a lot of room for problems and risks in the market when they happen to create big problems down the road. And so the shorter you tighten that up, the faster you pay off debt, the better off you're going to be. It's going to be cheaper, and you're going to pay it off faster, and you're going to lower those contribution rates sooner. So it's a good thing. So, that would be an area where, for instance, we think that, there should be some attention. Just looking at the amortization, how you're paying that debt. Looking at risk, your assumptions, those sorts of things that I've just talked about. So that's looking at the whole bucket of funding policy and assumptions and how much money is going in and that sort of thing. And then finally, making sure that you have a path to retirement security for everyone, active, future. And we also think that, again, towards that sort of modern workforce thing, we think a pension benefit is a very good thing out there, but we also think, it might be a good thing to have choices, for other types of folks who may not, be a full-term 30-year employee. And so having options out there is a pretty good thing. And we're gonna pivot into that. Because we're going to talk in a moment with the panel and a very good experience that has happened in Michigan that we'll come back to in a second. But you had a plan that was not in a dissimilar situation a few years ago where you had these debt payments escalating. Previous reforms hadn't done a lot to tackle this, and they had some issues with even making their full contribution rate, their payments. They weren't even paying the full bill for periods of time, which is really a bad thing for a pension plan. And so you'll hear from the champion in a second, but one of the things that they've done a lot of reform in their teacher plan, but they have moved in, not only are they working on the assumption side by lowering that assumed rate of return, they've introduced now, as of February of this year, it's up and running, all new teachers and school district and school employees in Michigan now have a choice of either a defined benefit pension or a defined contribution plan, and they can sort of choose the benefit that is the best fit for them. They put in a one-time money, to a couple $100 million, to start paying down that unfunded liability. And then this year have basically through an interesting mechanism of basically rejiggering the amortization schedule to basically turn on the spigot and put more funding into that plan now. And so we'll talk with the sponsor of that in a minute about the experience there. But what's been the outcome? The outcome has been, well, you've seen an interesting thing. Last year, talking about plan design, those things get very complicated. You guys probably went through that when you did the Georgia ERS hybrid plan a few years ago. People get nervous. They get emotional, and it's a very complicated political thing. And that was manifest last year because the votes to get the big bill out with the plan design changes was a pretty tight margins in both houses. This year, coming back around with that, what I would argue is probably a more complicated, policy question, which is how do we put a lot more money into this plan over the next several decades? Were unanimous changes and unanimously passed in both chambers and signed by the governor. And so, we think that reflects maybe a growing awareness in Michigan of the importance of solvency. And to put a point on it, this is why if you are successful at this, one of the potential outcomes you can get is what Michigan just had, which is an increase in the state's credit rating, one of 3 over the last few years in the country, and pension reform was cited as a key factor there. So with that, I will turn this over to the panel, and I'd like to ask Representative Tom Albert from Michigan and Representative Chuck Martin to go ahead and come up. All right. Well, thank you, gentlemen. Let me just give a couple of introductions here. First, I'd like to introduce Representative Tom Albert. He's been in the Michigan House since 2016. He is the chairman of the Financial Liabilities Reform Committee in the House. Born and raised in West Michigan, graduated from University of Michigan with a political science and history degree, served in the Marines, was deployed as an advisor to the Iraqi Army, then graduated from Michigan State University with an MBA, finance, and worked as an investor for the state of Michigan in the Treasury and doing investments for the pension fund. He's a chartered alternative investment analyst and has his wife Erica and 3 kids. And we appreciate him being here. And I just have to say it's been a pleasure to work with him because, he came in and did pension reform as a freshman, which is a really challenging thing to do. And so it's a notable accomplishment. So we're going to talk to him about that experience. And then also, I'm assuming that everyone in the room knows Rep. Martin, but Representative Chuck Martin is currently in his 8th term in the House, and he represents the Alpharetta, Roswell, Johns Creek area. He serves as the chairman of the Budget and Fiscal Affairs Oversight Committee and a number of other committees, and was also a mayor and city councilman from Alpharetta. So it's been a pleasure, and I just have to say, Rep. Martin, I want to acknowledge you because you invited, I know we spoke together at a GPPF event earlier this year, and then you brought me into your committee to talk about this issue, and so it's something that has been on your radar for a while now. So just I want to talk to you about what drove that. So let's just dive in for a minute. I want to just sort of pick up on the theme of where we were on Michigan. So Representative Albert, can you please just sort of walk us through what was the shape of the pension system, the teacher pension system in Michigan when you walked into office, and what prompted you to take the lead on reform?
Yeah, so I think just that your presentation was great because it gave me some context to have how much worse Michigan was than you guys here in Georgia. I guess just some high-level numbers. I like to think of it, you guys were just looked at pension numbers, but in Michigan we have a pretty substantial amount of retiree health care promises that have been made as well. So if you kind of sum those two numbers together, we have about $48 billion in assets for pension and healthcare. We have about $40 billion in debt for the two. And so it was 30 billion of that 40 was for pensions and 10 was for retiree healthcare. And that was about 55% funded for the both of them. If you look at how much money we're putting into, though, put $3 billion in contributions in just the previous year from when I started for just the payment. That was 36% of all payroll in all the state of Michigan. That was a quarter of all school aid fund revenue that we raised went to pay for our obligations, and that's taking a substantial amount of money out of the classroom. And I think just one thing that's important to note, if you looked at the $30 billion of pension debt, where did that come from? And they had that graph that kind of had the attribution analysis of like the 4 or 5 different areas to see, where was the debt created. In Michigan, 20 billion of the 30 billion of pension debt came from the assumed rate of return being off. And if you look, well, how far was it? It must have been terribly far off for it to create $20 billion worth of debt. We had an assumed rate of return of 8% and an actual return of 7.2%. So being off by 0.8%, timing is very important. There's a lot of factors that go into it. But these assumptions being a little bit off can have just substantial consequences. And a lot of this debt that was created, my kids are going to have to pay for it, and they didn't even render those services. So that was kind of what drove me on a daily basis to address these problems.
So you dove into the effort, and what sort of challenges did you run into along the way, resistance points? What can you just explain, politically, what did you think it was going to be, and what was it, and can you reflect back on your experience?
Yeah, well, I'm not an 8-term member, so it was kind of, I guess, a culture shock going into a whole new world for me. So that was kind of one issue. I don't know, has anyone seen One Flew Over the Cuckoo's Nest? kind of like that, I suppose. The hardest part for me was just, working in investments and coming from getting an MBA, I kind of felt like I was dealing in a world of rational thinkers. And then I moved to the legislature, and pensions are an emotional issue. My dad's a retired teacher, and I have tons of family that are retirees of the state of Michigan. It's not just a world of rational thinking. This is an emotional issue, and trying to address irrational comments in a patient and well thought out manner was challenging. People say, well, can't we just wait and see what's going to happen? It's well, we've done that for 20 years. We're in terrible shape. How about we don't burden our kids with this like the last generation did with my generation? So, when I talk about resistance and challenges, I think that was the biggest thing, was just trying to convince people that there's actually a problem. And, I think we successfully did that.
Well, Rep. Martin, speaking to problems, what got you interested in looking at the solvency of Georgia TRS?
Well, I guess I'm not near as smart as the gentleman that did it in his freshman year. It took several terms for me to focus on it, but I think it comes down to this. Just what he said is people want to wait and see, because it's probably going to be okay for the next 6 or 8 or 10 years, maybe even 15 years, and the increase in the money that goes into the pensions may go up, but in general, things have been good in Georgia and budget-wise since 2009, and the projects that people need and the services and a safe Georgia and an educated Georgia and all the things that Governor Deal has led on and the folks in the legislature, our leaders have funded have been okay. But when you look at it, is the math matters here, and the math doesn't change. We all know the rule of 72s. We know compounded interest. If you listen to anyone from Warren Buffett to your investment advisor at home, they're going to tell you if you invest early, you get a compounding of that. And so I saw the hole in our system. The gentleman also mentioned what we called OPEB, other post-employment benefits, health care for retirees in Georgia, that we fund on an annual basis, that a few years ago was over $500 million a year. When you take those and the additional contribution we made in this past budget into TRS, it was $2.5 billion. And as you said, Lynn, it's not enough. If you will, we're behind on our mortgage, these promises to retired teachers and educators that are in the system. And there are a lot of things and a lot of competition going on for budget dollars in Georgia. And I believe, many of my colleagues, if not most of them, in the legislature, think we should honor the promises that we've made, and that this TRS system and ERS system and the other pensions, defined benefit plans, have to be taken care of. And wishing for a super stock market and a 15% rate of return over the next few years is not going to do it, and not going to give us those things you said that you get. One other thing, if I can quickly, is pension reform. Maybe you found anytime you say pension reform to people that are getting a check out of the system, or that are paying into the system and would soon be getting a check out of the system, when you say those two words, pension reform, what they hear is, I get less money. That's absolutely the thing that surprised me most. I assumed people would take us on our word when we started to discuss this, that this is not about taking benefits away or cutting benefits or trying to shave something off. This is about stabilizing the system. So I want everybody loud and clear from my standpoint today as an advocate for pension reform. What that means to me is reforming a system so that it's solvent, stable, and can honor the commitments to our current retirees and our current teachers. So please understand that. Everyone I've spoken to in the legislature about it believes the same thing. So please don't have that knee-jerk reaction that reform means something gets taken away.
No, that's a very good point. We've had that on my team. We've had that experience in a number of jurisdictions where you start to have that conversation, and then people's defense mechanisms go up, and the walls they get guarded. And we had an experience in my state of Arizona where we worked with, it ended up about a year with the police and fire associations throughout the state. Where basically we were all brought together to try to hammer out a reform by our legislature, and they said, look. It's like, we know this is hurting cats, but go figure this out. You guys figure this out. And we did. And we all worked together and collaborated. And what it took was really a shared understanding of what the problem was and what the risks were. And once, I had to stand in front of rooms of hundreds of, active and retired police, firefighters, and explain and take lots of questions, and people address a lot of fears because you start talking about that. You just start talking about reforming a pension system to keep it solvent, and people do go there. They do think that. But the reality is, I think the communication is, the reason you reform is to be able to pay those benefits. And one of the ground rules in the work we did with the Arizona Public Safety, which passed overwhelmingly and was very big bipartisan success, first big major public safety plan in the country, really had a major reform with the unions there at the table guiding it with us. One of the ground rules was, look, whatever, we're going to put a new plan in place for new people moving forward. It looked a lot like actually what Rep. Albert did in Michigan in terms of a choice. But one of the ground rules was that on the pension side, the benefit has to be basically the same dollar benefit, but we're flexible in terms of how we look at cost and risk sharing underneath that. So you can do, basically, there is no cookie cutter approach, just to amplify and build off of Rep. Martin's point. There's no cookie cutter approach to pension reform. You take 10 different pension reforms across the country, and you're going to see 10 different things, and each one is a snowflake, and they need localized solutions. And so, there's no, this is something that needs to be gone in with a, surgical precision, with people, local context, stakeholders that know what's going on and have an interest in this, and collaborate and figure out a way forward to address the goals that I think I would think if you actually got the rational situation that you'd like, people would agree that yes, $20 to $25 billion of unfunded liabilities promises basically getting ready to be, not anytime soon, but a potential that they could be broken. That's a risk, nobody wants that. But how can you make sure that doesn't happen? That's an important thing. And if you can get a shared vision of why that's important to tackle, both for the sort of taxpayer / policymaker side, and also for the recipients who get those benefits, I think it's important. So kind of building off that, then, Rep. Martin. So when you think about what you'd like to see in the future, what sort of objectives would you have in mind walking into that kind of discussion?
Well, I think the first thing we have to acknowledge, and I'm hesitant to say this, but the numbers are the numbers. Math matters. Math doesn't change. Is this is not going to be something that is going to cut the expense to the state in the short and medium term. This is going to cost more money. And now is the time to do that when our economy is good, when we have the opportunity economically to do it with the least impact on the taxpayer. And Lynn, you can help me out here. You're the numbers guy. I used to be, and this number of years out of school, you're way ahead of me. But if we're $20 billion behind and we're assuming a 7.5% rate of return, so that's $20 billion we don't have in the system. And what you mentioned, we're not catching up with the interest. 7.5% of $20 billion is $1.5 billion. So next year, as a year goes by, we accrue another $1.5 billion that we have to amortize and pay back over the next 30 years. So we're chasing an unfunded amount of money that is not going away. So it would be like re-amortizing your mortgage every year for 30 more years. You're never going to get to do that. So what I would like to see, without having the specifics of, is take our current TRS system for all the retired teachers, for all the teachers that are in it, and put that aside and honor those commitments to that, so that if we put a new system in place for new people that, again, may have a similar benefit, that the people that are in the system, our retirees, our current teachers that are in the system, and that whether they're 2 years, 10 years, or 28 years into the system, understand that what we're doing with the new system cannot, by law, impact negatively their situation. What those two things then become, I think we have to have conversations with our educators, the people that are covered, the taxpayers in the community that are going to pay the bills. But I think if you bifurcate those two sets of folks, sets of educators, the people that are in the current system understand and see that anything that will happen going forward will not negatively impact them. Just real quickly, there's always a pushback for a defined contribution system in TRS, because I think the TRS retirees and people that are in the system see that'll be less money going into the current system, and therefore they'll lose a benefit. We can't do that. We have a promise to them. But look back at what the gentleman put in his slide. Only 27% of the people that enter education in Georgia stay in it long enough to vest in this system. In the world we're in now, some counties have 600-800 teachers short this year. Maybe if we could make a benefit proposition, a retirement proposition for them that was better, that was more market 2018 driven, that we could help fill some of our teacher shortage situation. So that's what I see, sort of two systems, one to honor the commitments to our current retirees and current teachers, and one that you could go in if you're joining the system, which is not to say you couldn't choose the old one and just to keep it like it is. So give people choices, but honor those commitments.
Okay, thank you. Well, Rep. Albert, so if you had to boil down, what maybe success factors behind the reform effort there in Michigan, it was a difficult road, but what do you think? You ultimately prevailed, got a major reform done, came back around, did more this year. But what would you think if you had to break down maybe the top 3 things that were influential in making that happen?
Yes, if I could reflect back and kind of how we got from start to finish, one was just good timing. We had a Speaker of the House and a Senate Majority Leader. This was their #1 priority. So that was a lot of tailwinds just for me to be able to get the ball rolling. We did have some headwinds, though. The governor didn't want to do it. So, but at least the legislature really wanted to. The other was that we had pretty conservative majorities in both chambers. You don't have to be a conservative necessarily to support pension reform, but we had a lot of fiscal conservatives who want to look out and make sure that we're fiscally solvent to the long term. So that was another tailwind that we had. And I think probably the most important was just the facts. Like I talked earlier about some of those irrational arguments. Well, I was able to combat them just from pure factual information. When people would say, "Oh, pension reform, that's a cut," like Chuck said here, and it's not a cut, because in Michigan we have literally in our state constitution it says you cannot diminish or impair a vested pension benefit. It's specifically in there. So I would just tell, I can't do it. It's in our constitution. It's impossible for me to cut your benefit. No way. And that would calm people down because it was just a fact. And then what I was able to do was kind of what Len did earlier was just show, like, look, this is how bad our performance has been in the past. Let me show you the numbers, and I'd walk them through. And we have pretty strict term limits in Michigan. You can only serve 3 terms in the House. So what I did was I made a presentation very similar to what Len had, and I sat down with all of my my colleagues and explained to them what the problem was, and then I was able to show them how it's likely to continue into the future. So I think those are kind of the 3 things that made the reform a success.
Thank you. I've got one more question for Rep. Martin, then we'll open it up to some questions that we've got here. Actually, I've got one more question for Rep. Martin, and then a quick question for you, Rep. Albert. Just in terms, Rep. Martin, you when I was here, I think in April, presenting to your Oversight Committee, I remember you kind of speaking directly to teachers that day about it was about your intentions, and you were talking about your intention to make sure that benefits are there. But just, if you were talking to teachers right now, what would you tell them about how you think about this, and what's your intention and how you want to tackle this?
Yeah, I would go with this. I mean, there's something has been said recently about, one particular issue is leave that issue alone and let's work on this. Sometimes we get hung up on the retirement benefits. So I would say this to teachers is don't worry about the conversation that goes on if it's a DC plan or a defined contribution plan or a defined benefit plan. That conversation can go on about what may be the new system if we form one. What my focus wants to be, and what my word to you today is, my goal is to make solvent and solidify the financial base that is our current TRS system. Depending on the numbers, it could be 25 billion, it could be 20. The stock market may be up today, it may be 18 billion, but we're behind. And if we don't do something, we're going to get further behind. And there will be a day, I have to run for re-election this fall. It could be next January without me. I hope not. But there will be some point in time when that graph goes up, and instead of 22% of salary, it's 25 or 28. And at some point when you have to compete for a $3 or $4 billion infusion 10 or 12 years from now in a state budget, and there are other people competing for that money, I fear that there won't be the political will to do it. We have a good economy now in Georgia. We have an opportunity to work on this and to fix this. And today is the day, next year is the time to make this TRS system solvent and protect this benefit that has been promised to our retirees and our retired teachers. So my message is this is to keep our promises, not take anything away from you.
Thank you. I actually had that same conversation with my mother-in-law, who's actually in the Michigan teacher plan. And I came back from Lansing on one of the visits to see Rep. Albert here, and she said, "What are you guys doing?" I was like, "What do you mean?" She said, I'm getting this stuff from the MEA, that's the Michigan Education Association, talking about this stuff that's going on, and I'm worried. It sounds like you guys are like working to try to cut benefits." And I had that exact conversation. "Nana, no, it's not that. I'm actually trying to protect your benefit. Did you know that your system's like 30 billion underfunded? No. Do you know what that means? No." So that was a conversation that I find once you start to crack that open and you start to say, this is why this matters. It's not, this is not some abstract budget thing. This is about real people and real lives. I think people then, once you get past that initial emotional hurdle, you can have, reasonable conversations. Well, Rep. Albert, you've been a reform champion. You've taken arrows for your work. You've gotten praise for your efforts. And you're sitting here next to a prospective reformer like Rep. Martin. So what would you say to someone, what advice would you offer, lessons learned from your experience in walking through reform processes?
Well, it's hard making deals like this. I guess what the thing is, every legislature is different, every state's different, so it's hard. I can't tell you what worked in Michigan would work here, but I guess the only thing I could say is you have to find the leverage point that will work, and you have to use that leverage to get the deal. In Michigan, like I said, the governor was really opposed to it, but what the governor really wanted was get the budget done on time. That's his number one priority. He loves the budget. So what the leadership did was they kicked him out of the budget negotiations. and it created the leverage we needed to get a deal. I mean, what we ended up with wasn't what I originally had introduced. In fact, by the time I got done with it, I guess this leads to my second point of advice. By the time we got done, I felt like I walked away with nothing. I thought like the reform we did was almost meaningless by the time. And with big reform, there's such highs and lows. That was a low point. But just don't walk away, I guess, is the thing. Because looking back on it, I'm so glad I didn't, because it was a meaningful reform. And it was a bite of the apple, and it was a big one, and I was able to go back later on and take another bite of the apple in the same term. So, I guess if I had to summarize some advice, I'd say use the leverage when you can, and just don't walk away. Just take a bite of the apple.
And just quick follow-up on that. You did have 2 consecutive years of reform, and you had a much different experience this year than you did last year. And so what would you attribute that to? Just having and again, the more contentious part was a very thin margin in vote passing last year, very difficult. This year just seemed not sailed through, but unanimous passage and, relatively easier.
Yeah, I think kind of maybe a couple things. The second thing that we did dealt with debt structure. I care a lot about debt structure. A lot of the things moving to a DC plan, that deals with cash flows going forward. What I really care about is how are you going to pay this $40 billion of debt over time? That's, and what you were saying, you guys have like a rolling amortization of, you're always 30 years away. I care about, let's get to our maturity date. But I guess to answer your question, I think part of it was that the caucus was just really educated on it. We did the really big reform. They got really super educated and smart on the topic. And then when we went back for a different bite, they were like, yeah, that makes sense. So they were ready.
But not to, that sounds like a little diminished. Like what they said, yeah, all right, we're ready, was to spend a lot of money in the next couple of years, to basically turn on the spigot over the next decade or so, to increase contributions into this system. So it's not an insignificant thing to make a decision like that I realize this year, and we're a lot of budgets are relatively flush, but I don't think people are too sanguine about just spending lots of money these days after the experience we've had the last
decade. If I could maybe follow up a little bit, because that's definitely not how I positioned the argument.
Okay.
We spend a lot more money.
Yeah.
Sometimes it's better to be lucky than good. One thing that I negotiated to put in the original reform was that it was a contribution rate floor. Every year, we're not going to pay less than we did the year before. It makes sense, right? So nobody really refuted that, and we put it in there. Well, little did I know that accelerated our debt structure. We had our debt amortization to be paid off by the year 2038. And what that did is it fast-forwarded it to 2035. So I had 3 years to play around with. The governor basically has a hard set rule. He wants this debt paid off by 2038. So I said, hey, let's stretch this debt structure back out 3 years, and let's play with the payroll growth assumption. And then, that's what got the conversation started. So that was the leverage point I was able to use on that one.
Right. And just to be clear, what they're really doing is they're taking money that would have been spent 10 to 30 years from now and moving and pulling that up to spend it now. So not actually adding money, but shuffling the order and the timing, which is very important, as I mentioned. So we've got 2 more questions that have come. If any, please feel free to bring any others up in the final few minutes here. But one question from the audience is that I had mentioned that the unfunded liabilities here for TRS ranked in the middle of the pack, not great, not awful. And so the question is, how are some of the awful state systems going to resolve their crisis? And have they essentially missed their opportunity? And I think, some probably have. I won't name names. I think some have. Some, like Kentucky, for instance, had a very contentious battle on this issue this year, and it's one that they're one of those systems that is really going to they're going to reckon with this and struggle with it probably for a while. And it's going to, it's having major impacts in that state. It's going to have major impacts on their budget, but they've got to get through it. In Illinois or New Jersey situation, honestly, I don't know. It's a really difficult thing because some systems are past the point where tinkering around the edges or pulling levers, are going to get you that far. You might be looking at major, contribution increases, major budget trade-offs, that sort of thing. And so there is no good answer. Each context is really unique and the budget situation is really unique in that jurisdiction. So it's hard there's no cookie cutter approach, but I guess the way I would like to answer that question is to say that if you're Georgia TRS or many other plans out there right now that are in a similar boat, not bad off relative to others, reform now is the time to do it. You don't wait. Like that waiting, that's why New Jersey, Illinois, Kentucky, some of these places are having real problems. So you tackle it now before the crisis. Otherwise, you're going to be playing catch up. Because I guarantee you, right now we're what, 10 years off, almost 10 years off the last market crash. The next recession is coming. It's coming soon. It may not be that big, who knows, but it's coming sooner than the last one was. And so the 80%, 75 to 80% kind of funded ratio range, that at that point may be, hurt. And you want to kind of get in there and start working before those kind of situations happen. So that would be the way to answer that. I don't know if you guys have anything you want to add on that. And then why aren't the contributions from individual teachers increased to help with pension underfunding? So that's a political question. That's certainly one way that other states have looked about how can we increase both the employer and employee side, making fair, sort of balanced, share the pain, if you will. We saw that in Colorado this year, for instance, which was another big bipartisan reform that we were involved in. But that was one where both sides are gonna basically commit to stepping up their increases. In other states, in Arizona, our constitutional provision is even a little more strict than the one in Michigan. So our constitution literally says once a benefit has been set up, you can't touch it. And our Supreme Court interpreted that as even including the contribution rates. And so they tried to change a 50-50 cost share system in our teacher plan to a 53 employee, 47 employer plan a few years ago, and that 3% change got thrown out by the courts, and so for actives. And so you could do that prospectively, and that's usually where pension reform actually happens, is on the prospective end, because it's very difficult to modify benefits, benefit structures, contribution rates, and that sort of thing. COLAs, anything like that, can be, depending on your legal construct, very difficult to do, just given the way the courts have treated basically the implied contract status of defined benefit pensions. So with that, I think we're at the zero mark and we just wrapped up. And so thank you, everyone. Happy to answer any questions, and thank you to the panelists today for joining me.
All right. Well, thanks to our panel for that great discussion. That's going to segue into our lunch keynote speech by former San Jose Mayor Chuck Reed, who is another person who led a pension reform effort, and he's going to talk about that experience and what it meant and what lessons it may hold here for Georgia. Lunch we'll serve lunch before that. There will be a buffet outside. We'd like for everyone to go out for that and then come bring your plates back in to eat in here, and we'll get started with the program a little after noon. So thank you very much.